Good morning and welcome to the Lotus Resources Investor Webinar. All attendees are in a listen-only mode. If you would like to ask a question, please enter it into the Q&A panel within Zoom. I will now hand over to Lotus Resources Managing Director, Keith Bowes. Over to you, Keith.
Thank you very much, Nathan, and welcome to everyone who's listening. As Nathan has mentioned, my name is Keith Bowes and I'm the Managing Director of Lotus Resources. Lotus Resources acquired the Kalakira asset, which is a uranium asset located in Malawi in Central Africa, of Paladin Energy in March of last year. Just before I go through the detail of the presentation, obviously the disclaimers, the general disclaimers, which are also available on our website. I'd like to start off the presentation just talking about why Lotus was excited about the Kalakira asset and what was it about Kalakira that made Lotus acquire it. So there's a couple of things that I think are really important. First of all, we need to recognize that Kalakira itself is a proven uranium producer. So it operated between 2009 and 2014. And in that period, it produced about 11 million pounds, which importantly was all accepted by the conversion facilities in the West. So that includes Converdyn, Orano, and Cameco, and was also accepted by the utilities in the West as well. So why is that important for us? Well, we see that gives us a leg up maybe over some of our peers, because when we go out and market the product and we try to get our offtake agreements, we're dealing, or the utilities are dealing with a product that they already know and have already treated previously themselves. We also recognize that the existing facility itself, so the Kalakira plant, is capable of producing somewhere between 3 and 3.3 million pounds per annum of production. And when we look at our strategy for the restart of the project, we have no intentions of increasing that throughput rate. So we're very, very comfortable at a 3 million pound per annum rate. And what that means is that the money that Kalakira has already spent, we only need to spend a small amount of money in terms of refurbishing the plant. And the work that we did as part of our scoping study, which we announced to the market in October of last year, showed that our capital restart is around $50 million US. We also recognize, because we're a brownfield asset that is not looking at any expansions, has an existing plant and everything in place, the time that is required for us to come back online is relatively short compared to some of the other greenfield projects out there. One of the other things we're also excited about is that there's an existing resource associated with the asset of 37.5 million pounds. Now, when we acquired the asset and the mining license of Paladin, not only did we acquire those, but we also got a number of exploration licenses as well. And we've spent the last few months going through all of the historical data, and we believe there's some options for us to be able to increase that resource through some exploration activities. And we announced a few months ago that we'd started an exploration program, which consisted of a 5,000 meter RC drill program. And just as a last point as well, Lotus at the moment is in a very strong cash position. We have approximately $28 million in the bank as of the end of June. Part of that is a restricted cash component that is associated with our cash bond, which is associated itself with our environmental liabilities. But we effectively have $15 million unrestricted cash, which is more than sufficient to see us through to the end of next year, and will cover the number of activities that we're currently doing, including the care and maintenance of the asset, our corporate overheads, our exploration programs, and our feasibility study as well. Just whereabouts is the uranium market at the moment? And in our opinion, we're actually sitting in a perfect storm situation. I think everyone's realized what's happened with Sprott coming onto the market with their SPUT fund. They raised an initial $300 million and recently topped that up with another $1 billion being added to it. And they are very, very aggressively going and buying and picking up any spot uranium that is sitting in the market. When you listen to the thematics from a number of people in Europe, in the US, in Canada, and in Asia as well, I think it's becoming realized by everybody that any conversation that talks about zero carbon emissions has to include nuclear in any power supply. We also recognize at the same time there's an electrification revolution going on. We're seeing growth in GDP with associated increase in electricity demands. And we also recognize that electric vehicles are starting to have an impact in terms of total electricity demand as well. So uranium from that perspective has not only it can get effectively a double whammy approach to it, and that we would see the percentage of power that's generated by nuclear increasing to work on the greenhouse gas emissions and carbon emissions. But we also recognize that in general, the electricity consumption in the world's going up, and we would expect the nuclear components of that to increase at the same time. Looking very, very simply going forward, and even on a conservative basis, we believe there's a significant shortfall of uranium supply, and that could be as much as 30 million pounds in 2024 and growing to as high as 60 million pounds by 2028. We also know through the conversations we've had with a number of utilities, a number of them signed up to long-term contracts in 2008, 2009, 2010. These long-term contracts are generally about 10 years in length, and we would see a number of them coming off contract at the moment. And our expectation is these utilities are required to re-enter the term contract market in a relatively short time frame as well, which would provide additional impetus to the price going forward. Just want to quickly talk about some of our peers as well. So I think everyone recognizes that the uranium market is cyclical in nature. We've had the peaks in 2007, peaks in 2011, and a smaller peak in 2015 as well. Now, when you talk about a cyclical nature, we think we're at the start of a new one now. And what are the companies that are going to be able to take advantage of this new cycle moving forward? Well, in our opinion, it's the companies that have assets that are currently in care and maintenance. And when you look around the globe, what are those companies? There's potentially 6 of them out there at the moment. Cameco being one of them, has 2 very, very large assets that are on care and maintenance. Those are MacArthur River and Rabbit Lake. You have Paladin and the Langer Heinrich asset as well, which is located in Namibia. And then you have ourselves with our Kalakira asset in Malawi. Now, it's important to note, of all the assets that are on care and maintenance, the Kalakira asset is the 4th largest producer. So our 3 million pounds is the 4th largest one out there. There's also Energy Fuels, which has got a number of assets in the US, Boston Peninsula are the other 2 ones. And we believe that these companies are the ones that will be able to take advantage of the current cycle that looks like it's starting. Now, some of the other companies out there that are maybe more greenfield in nature, their time frame is probably a little bit further than that, and they would look at maybe a second cycle coming through. But one of the other things I want to talk about is when you look at our market capitalization against our peers using this criteria, our market capitalization is relatively low. Our current market capitalization of $235 million US compared to the Paladin's 1.7 and even Energy Fuels, which has got 2 smaller projects than us at $1.1 billion. So we believe there's potential significant growth within our share price and with our market cap. And one of the questions we often get asked is, well, why is your market cap so low? And I think there's a couple of reasons for that. First of all, when Kalakira was actually associated or part of the Paladin umbrella, Paladin's primary focus was on their Langer Heinrich operation, and Kalakira was seen as almost a poor cousin to Langer Heinrich. Now that it's come out and it's in its own company, obviously we talk a lot more about it. We can get the story out more to potential investors. The other one, I think, is that perhaps because of the asset being located in Malawi, Malawi is perhaps not a well-known mining jurisdiction. However, we believe the sovereign risk is relatively low, and we're very, very comfortable operating in Malawi. Just want to talk a little bit about where we are at the moment. So as we've said, Kalakira is a proven 3 million pound per annum producer. We have existing infrastructure on site. So we're capable of producing or operating at 1.4 to 1.5 million tons per annum. But importantly as well, is we've also recognized that since the asset shut down in 2014, there's been some advancements in various technologies that we think the Kalakira asset can benefit from, and we would see those improving the project economics as we move forward. It's also important to note that we have the majority of our major licenses in place. We have an environmental license already, and we recently announced that our mining license had been extended for another 15 years. And as I mentioned on the introductory slide as well, there's also some exploration upside, and we have multiple near mine untested targets that we're currently drilling. Just talk a little bit about the recommencement of how we plan restarting the asset back up again. So we did a scoping study last year, which we announced to the market in October, that really set the base case for the project. Coming out of that, we showed that we could produce at about 2.4 million pounds per annum average life of mine production at around $33 per pound. But what we really used that scoping study for was to try and identify what are the key cost or key value drivers for the project. And when we had a look at those, we've come up with 4 things that we think we can do that will add significant value to the project. Those include in implementing technologies such as ore sorting, which allows us to increase the grade of our material, of our feed material going into the plant. We're looking at options around power supply. So the existing facility itself operates with diesel gensets that are relatively expensive. We believe there's some opportunities to connect to the national grid or to recover power off our acid plant. We also recognize acid is a very, very large part of our operating costs. And we believe there's some ideas on there around recycling the acid, better utilization of the acid. And then the last point is really to do with our tailings dams. There's an existing tailings dam on site that has the capacity for about 5 to 6 years worth of production. After that, there's a requirement to build a new tailings dam. Obviously, there's a significant cost associated with that. And we're looking at some alternatives, including using in-pit disposal for our tailings, which we believe is a much cheaper option. So the results from all these studies that we're doing will be fed into our feasibility study, and we expect to be able to announce the results of our feasibility study to the market in June or July of next year. Just want to talk a little bit about ore sorting because it is a key part of our restart plans. So ore sorting technology is a technology that has been around and has been in the recycling industry for many, many years. Moved into the mining industry probably about 8 years ago or so, and has been used by a number of operations in Australia, looking at nickel, looking at gold, looking at manganese, and looking at iron ore as well. Now, what we see ore sorting can do for us, it can upgrade our feed materials. So what can we do with that? Well, there's 3 different things we can potentially have a look at. First of all, we could increase the grade of our general run of mine material. So taking it from maybe this 900 or 1000 ppm up to 1300 ppm, which would allow us to increase our production rates. So as I said in the scoping study, we were 2.4 million pounds. If we implement ore sorting, we can easily achieve 3 million pounds per annum through the plant. Alternatively, or maybe at the same time, we can also look at converting a number of the stockpiles that are currently on surface that are lower grade, between 350 and 450 ppm, feed those through the ore sorter, take the grades up to around 700 or 800 ppm, and then feed that into the plant. Now, those materials, when upgraded, become very, very economic and allow us to extend the life of mine as well. And then just the third area we have recognized through the test work that we've been doing is that we can decrease our operating costs by using ore sorting, whether that be indirectly through the dilution of our fixed component or by the reduction in acid consumption. Those are the 2 things that sit up there at the moment. Just want to quickly talk about the power one, because again, that's also really important. So as I mentioned, the existing acid runs off diesel gensets. We're looking at connecting to the national grid, although we do recognize that power, the availability of power in Malawi and as well as the reliability is quite low. So therefore we cannot be completely reliant on the grid, and we need to look at some hybrid options that would compensate or be able to work with the grid. And we're looking there at taking power off the acid plant by retrofitting a steam turbine. And we're also looking at some renewable options as well, whether that be solar or wind, which will then allow us to only use the diesel gensets as backup power. By implementing this hybrid option, we believe we can halve our power costs. So our diesel gensets at the moment cost somewhere between 28 and 32 US cents per kilowatt hour. By implementing these ideas, we think we can get our power costs down to around 15 or 16 cents per kilowatt hour. Just quickly touch on the exploration as well. So we've got a 5,000 meter RC drill program at the moment that we've just completed. That RC drill program is focused on 2 main things: extending our uranium mineralization, specifically around our pit, where we've identified some extensions on the geology. So we should be able to increase our resource there, push our pit shells out, and be able to collect more material to feed into the plant. And then the other one we're having a look at as well, it's something that's not our core focus, but is certainly of interest to us, is there's a rare earth deposit that's probably about 2 kilometers to the north of our pit. We're doing a bit of work around that to understand what the size and the extent of that is. We've seen some really high grades from some samples that we took last year, and we just want to try and get an idea of the size of the footprint, the potential depth of the mineralization as well, so we can work out how best to get value for Lotus from this. And there's a couple of options available to us. We could either look at developing it ourselves, we could look for a JV partner, or potentially look at spinning it out as well. So really just to summarize then, why do we believe Lotus is well positioned for the next uranium cycle? Well, we're a proven producer, as I've mentioned. We have a very strong cash position at the moment. There's significant value upside for our investors when you compare us to our peers. And we believe there's also some significant value upside for the project when we start to put through these new technologies that we're talking about, as well as the exploration potential as well. There's a strong board and management in place that has got both African and uranium experience. And as I mentioned, we're a relatively low capex as well. So with regard to raising capital for the restart, we think that's a relatively simple exercise when you look at the $50 million compared to our current market cap of around 320 million Australian, or about 240 million US at the moment. So Nathan, that's the end of the presentation. I'm happy to take any questions that anybody has.
Thanks, Keith. If you'd like to ask a question, please enter it into the Q&A panel within Zoom. The first question is, with regards to contracting, what are the plans to ensure Lotus can take advantage of much higher prices over the expected uranium bull market?
So at the moment, from our marketing perspective, we're not intending to sign any contracts in the short term. We're starting to build the relationships with the various utilities over in North America, both in USA and in Canada. And we appointed a marketing consultant a few months ago who's really driving that work. The way that we look at contracting, the way we're probably going to set ourselves up, is that we recognize a few things. First of all, we will split our contracts up. We will want to have some term contracts, and we'll probably leave some material to go onto the spot market. But the way that I'm thinking about it is that depending on the price we can sign our contracts at, we will always want to make sure that all of our operating costs are covered by these long-term contracts. So for example, if we could sign a contract at $65 per pound, we will probably place 50 or 60% of our production into those term contracts, make sure we cover all of our costs, and then leave the remaining 40 or 50% of material to go onto the spot market. If we were able to get higher contract prices, of course, the percentage we put into the contract may reduce further, and we'll have more material to go into the spot market. But these are discussions that we've only started having now. And as I said, we have no intentions of signing any contracts in the short term. We will be looking at doing that after we've completed our feasibility study.
Thank you, Keith. The next question is related to the DFS, and the question goes, how quickly can you commence production post the DFS?
So the timeline that we have in our mind at the moment is that we complete the feasibility study in the middle of next year. We spend sort of 6 months or so doing the debt financing, the equity financing to raise the required capital. We do our negotiations around the off-tax agreements and all that, such that we can make a final investment decision towards the end of next year. And our current understanding through the conversation with our engineers and all that, it'll take about 12 to maybe 15 months to restart the asset back up again. So we could be up and producing by Q1 2024, and that's calendar year 2024.
Thank you. And just further on the production. So he says, when you talk about ore sorting leading to an increase in annual production to 3 million pounds per annum, is the 3 million pounds per annum locked in or aspirational?
I think there's a couple of things. First of all, we need to do some more work to confirm the results from the ore sorting test work. We've done 2 programs already. We have a 3rd program planned, so we just want to tick the box to make sure that everything works. Now, as part of the feasibility study, I think what we're going to do, we're going to have a look at some sensitivity analysis. Is it better for us to increase our production rate and have a slightly lower recovery associated with it, of course, because we do have some waste material that comes out of ore sorting, and run at that 3 million pounds for maybe 7 or 8 years? Or is it a better option for us to maintain a 2.5 million pound per annum with a slightly higher recovery and then include the the waste material or the lower grade mineralized material coming in. So we haven't confirmed which way we're going to go yet. That's going to be part of the outcomes from the feasibility study.
Oh, and the next one, the next question is, does the processing plant scale of 1 million pounds per annum limit annual production? For instance, how do you achieve 3 million pounds per annum with a processing plant at 1.4 million pounds per annum?
The 1.4 million is tons per annum. So 1.4 million tons per annum. Understood. So that's what we're constrained by the front end of the circuit of how much ore we can feed into it. And then we're talking about a 3 million pound per annum production. So obviously, if we're constrained by the tons, the ore tons going in the front end, the grade dictates what the pounds are going to be that we produce. And that's where the ore sorting comes in. If we're feeding 900 ppm, we produce 2.5 million pounds. If we feed in 1,200 ppm, then we can produce the 3 million pounds.
Understood. The next one's regarding the rare earth project. One person here is worried about it being a distraction for the company. I guess, how do you make sure that it's not a distraction, I guess, is the question he's asking.
I suppose, I mean, we've obviously said that we are interested in the rare earths. We think there's something there, but it's certainly not our primary focus. I mean, all of the money or the majority of the dollars that we're spending are certainly focused on uranium in terms of not only the exploration program we've done, but also all of the study work we're doing at the moment. The majority of our budget over the next 12 months is focused on the uranium space. The rare earths is a nice little thing to have on the side. And as I also mentioned, if we do find something there that is of interest and we think can add value to the company, well, what is the best way for us to crystallize that value? Do we go into a JV and hand it across to somebody else and let them do it and we just focus on the uranium, or do we spin it out so we can focus on the uranium as well? Those are the options that are available to us. But I think we want to get a better understanding of what is actually there before we enter into any discussions like that.
Thanks, Keith. And another one back to uranium. What scope is there to increase the resource base?
So there's a couple of things we can have a look at. So as I mentioned, we're doing this 5,000 meter drill program at the moment, which is looking at extending the existing resource of the Kalakira resource itself. We did identify a number of radiometric anomalies to the south of the existing pit. So that's still within our existing mining license, but it's about 2 to 3 kilometers away from the pit. So we've got some options there to do some drilling there and see whether we can convert those into satellite deposits. But also what we've done is when we acquired the asset of Paladin, there were an additional 5 exploration licenses that we received as well. And we've started having a look through all of that information. And we think there's some potential on some of those as well. So we could end up finding some more uranium on those exploration licenses. And then, of course, at the same time, we are keeping our eye out in terms of Malawi in general. Are there any other areas in Malawi that maybe we should go and peg some ground?
And next one, Keith, is just someone asking for more detail on the cash position of the company, and how is it possible that the current cash position can last until the end of next year?
Well, we have $28 million at the moment. As I said previously, some of that is restricted. So there's $10 million is in a cash bond, which is associated with our environmental liability. But that means we have 15 million unrestricted cash. And that $15 million is sufficient to look at our care and maintenance costs, which run at about $2.5 million, enough for our drill program, which is about $1 million, enough for our studies, which is about $5 million, and enough for our corporate overheads, which run at about $1.5 million. So that cash will last us until the end of next year. It's also important to note that we divested our Hylea asset a few months ago. We received $1 million in cash for that. And we've actually just gone through, and we actually announced it this morning, that the shares that we got as part of that, Sunrise shares, we've come up with a deal with Sunrise where we've actually sold those shares as well. So we got $2.2 million in total from the sale or from the divestment of Hylea. We also have a number of options out there as well at the moment. So there's about 40 million options still left that are well in the money. They've got a strike price or an exercise price of 4 cents. A lot of them have been exercised, but as I said, there's still about 40 million left at the moment. And in fact, our cash position hasn't changed for the last 2 quarters or so. All the option money that comes in has actually covered all of our costs up until now. So we believe we're well cashed up at this stage.
Thanks, Keith. There are no further questions at this time, so I'll now hand back to you for closing remarks.
Oh, great. Thanks very much, Nathan. So, just as a real closing mark, guys, I think there's been some really big changes in the uranium space in the last couple of weeks with Spot coming on board, mopping up all the uranium, the spare uranium on the spot market. We've seen this increase in the spot price now going from the $32 to the $51 on Monday and probably around $50 today. What we're interested in a company, though, is really the term price. And we do recognize that the term price follows the spot price. So we're hoping within the next few months or so, we're going to start to see that term price come up as well. But I think it's important to note, and most companies talk the same thing as well when you talk to the developers, even at $50 per pound, the price is probably still a little too low for us to make any financial investment or final investment decisions. We would want to see a price that's more in the 60s or so, being able to make that. And we're confident that that's going to happen within the near future as well.